Canada posted its first trade surplus in 6 months, but not for any reason its own government planned. The war in Iran sent crude prices surging and gold demand spiking, and the arithmetic followed. Statistics Canada reported a $1.78 billion surplus in March, reversing a $5.11 billion deficit from the prior month. Energy exports jumped 15.6% to their highest level since September 2022. Metal and non-metallic product exports rose 24% to a record high. Analysts had forecast a deficit of $2.88 billion. The actual number came in more than $4 billion in the other direction. The mechanism runs through the Strait of Hormuz. Naval escalation there has effectively shut the world's most important oil shipping lane. Some 11 million barrels per day of Middle Eastern production is either offline or stuck in storage, unable to move. Iraq is offering discounts of up to $33 per barrel just to find buyers willing to route shipments around the blockade. The U.S. Strategic Petroleum Reserve shed another 5.2 million barrels in a single week ending May 1, a rate of depletion that cannot hold indefinitely. Against that backdrop, Canadian crude suddenly commands a premium by being available, deliverable, and priced in a market that has no alternative. The checkoff detail here is the $7.1 billion trade surplus Canada ran specifically with the United States in March, the highest in 6 months, reached even as Canada actively diversified away from American buyers. Exports to non-U.S. countries hit a new record high. Canada's share of total exports bore its going wet of struck to 66.7%, its lowest ever. The Iran war, in other words, is doing what Ottawa's trade policy has been trying to do for years, forcing diversification by raising the value of what Canada sells to the rest of the world. But the surplus that saved the headline number created a problem for Tiff Macklem. The Bank of Canada held its key rate at 2.25% this week, its fourth consecutive hold, while explicitly warning that future moves are now a fork, not a lean. High oil prices are inflationary, which points toward hikes. Weak domestic demand and U.S. tariff drag point toward cuts. Macklem said both directions are possible. Markets are pricing in 2 25 basis point cuts by year end, but that path only survives if energy prices ease. If the Hormuz blockade holds through June, those cut bets look increasingly fragile.
That same war driving Canada's energy windfall is now quietly dismantling the global copper supply chain through a channel most investors haven't tracked yet. The Strait of Hormuz carries roughly 49% of the world's traded sulfur, according to the International Fertilizer Association. Sulfur is the feedstock for sulfuric acid, and about 1/5 of the world's copper is produced through a refining process called SXEW, which cannot operate without it. Since the Hormuz Ulster began, sulfuric acid prices have nearly doubled. Sprott Asset Management laid out the mechanics this week. Approximately 4.8 million metric tons of annual copper mine supply depends structurally on that acid supply. The production impact won't be visible in this week's output data. Most miners have existing inventory and in-transit shipments buffering the immediate hit. But Sprott's analysis is explicit. The disruption is real. It compounds over months, and it raises costs across the entire SXEW segment even before any mine goes offline. The demand side is moving in the same direction. Iran-driven energy insecurity is accelerating the case for electrification globally. Solar, wind, grid expansion, and data center infrastructure all require copper at scale. Sprott estimates that by 2040, these strategic segments could account for 45% of total copper demand, up from 32% in 2024. Critically, Sprott analyst Jacob White noted this demand is significantly less price-sensitive than traditional cyclical consumption. Grid modernization doesn't pause because commodity prices are elevated. At the current spot price of $13,000 per ton, virtually every copper mine in the world is operating below its all-in sustaining cost, meaning every mine is profitable at current prices. Copper mining equities ended April of 7.98%, outpacing the metal itself. The counter-signal that would break this case, a rapid Hormuz ceasefire that restores sulfur flows and collapses the asset price premium before supply disruptions compound into actual output cuts. Watch sulfuric acid spot prices as the first verification point. If acid prices hold above double their pre-war level through mid-May, the supply squeeze becomes structural, not temporary.
The same week Canada's energy exporters posted record numbers, the country's most watched technology company delivered a different kind of result, and the market punished the gap between what happened and what comes next. Shopify reported first quarter revenue of $3.17 billion, up 34.3% year over year, beating analyst estimates. Adjusted earnings per share of 36 cents beat the 33-cent consensus. The headline numbers were strong. The stock fell 9.3% on the open and extended losses through the session. The cause was the forward guidance. Shopify told investors to expect second quarter revenue of approximately $3.42 billion, a year-over-year growth rate of 27.5%. That is a meaningful deceleration from the 34% pace just reported, and the operating profit forecast came in below expectations as well. For a stock trading at 115 times earnings, even a modest step down in growth trajectory carries an outsized price consequence. President Harley Finkelstein used the earnings call to make the case that AI is now Shopify's native operating model. AI handles over half the coding done internally, headcount has been flat for 3 years, and the company shipped more than 300 products and features last year without adding staff. The efficiency story is real, but the growth deceleration is also real, and the two don't automatically coexist without friction. When AI is presented as both the cost discipline engine and the growth catalyst, a simultaneous slowdown in revenue growth raises a question the call didn't resolve. Which is it right now? The weight of evidence here leans cautious. Shopify is down 29.9% since the start of the year, and trading nearly 40% below its 52-week high. The $2 billion buyback announced alongside results provides a floor, and the 34% Q1 growth rate shows the underlying demand engine still runs. The recovery case requires Q2 results to come in at or above the $3.42 billion guided figure, a threshold the market will watch closely on the next print. If guidance is met and Q3 commentary stabilizes the deceleration narrative, the sell-off looks like an overreaction to a single number. The counter-signal to watch: if Q2 comes in below the guided $3.42 billion, it confirms the slowdown is real, and the AI efficiency story is not yet translating into revenue acceleration. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.